We're witnessing something in the physical silver market that hasn't happened at this scale in modern financial history. And whether you own silver or not, what's unfolding has implications that extend far beyond one metal or one market. This isn't about price predictions. It's not about getting rich quickly. It's about understanding a structural problem in the global financial system that's becoming impossible to ignore. And if you're someone who values clarity over hype, who wants to understand what's actually happening beneath the surface of markets, then what I'm about to explain matters deeply. Let me be direct with you. There are serious people in the financial industry, analysts who've spent decades studying commodity markets and derivatives, who are raising concerns about potential delivery failures in the silver market. These aren't conspiracy theorists. They're individuals who understand how physical markets interact with paper markets, and they're seeing patterns that suggest significant stress in their system. The reason this matters goes beyond silver itself. It touches on how modern markets function, how derivatives amplify risk, and what happens when the difference between what exists on paper and what exists in physical reality becomes too wide to reconcile. So let's walk through this carefully. Let's examine what's changed, why it matters, and what it means for anyone trying to navigate markets with intelligence and preparation rather than emotion and reaction. Before we discuss what's happening now, you need to understand a fundamental concept that most investors never think about. There are two silver markets operating simultaneously, and they're connected but not identical. There's the physical market. This is actual silver, bars, in vaults, coins and collections, metal that exists in three-dimensional space. That has weight and volume. That can be touched and verified. Then there's the paper market. This is contracts, futures, options, certificates, and various derivatives that represent claims on silver. These are legal agreements, entries in ledgers, electronic records that say someone owns silver or has the right to silver under certain conditions. In theory, these two markets should track each other closely. The paper market provides liquidity and price discovery. The physical market provides the underlying reality that gives those paper contracts meaning. But here's what most people don't realize. The paper market for silver is many times larger than the physical market, depending on how you measure it. There are estimates suggesting anywhere from 100 to several hundred ounces of paper silver. Claims for every ounce of physical silver that actually exists and is available for delivery. Think about that for a moment. If you have 100 people holding contracts that say they own 1 ounce of silver, but there's only one physical ounce available, what happens when multiple people decide they want to take physical delivery at the same time? This is the essence of what some analysts are concerned about. Not a theoretical concern, not a distant possibility, but a structural vulnerability that exists right now in how silver markets are organized. You might be thinking, well, don't all commodity markets work this way? Don't we always have more paper claims than physical inventory? To some degree, yes. But silver occupies a unique position. It's both an industrial metal and a monetary metal. It has thousands of industrial applications, from electronics to solar panels to medical devices. Industries need physical silver to function. They can't substitute a contract for the actual metal when they're manufacturing a product. At the same time, silver has a 5,000-year history as money. It's been used as a store of value, a medium of exchange, a unit of account across virtually every civilization that's existed. That monetary function never completely disappeared, even after governments moved to fiat currency systems. So, you have two sources of demand: industrial users who need physical metal for production, and investors or savers who view silver as a hedge against currency debasement, inflation, or financial system instability. When both types of demand increase simultaneously, something has to give. Either the price rises dramatically to ration available supply, or delivery failures occur because there simply isn't enough physical metal to satisfy all the claims. And this is where derivatives enter the picture in a significant way. Let's talk about what derivatives actually are, in plain language, because this is where the real systemic risk lives. A derivative is a financial contract whose value is derived from an underlying asset. In this case, the underlying asset is silver, futures contracts, options, swaps, structured products. All of these are derivatives. The derivatives market serves legitimate purposes. It allows producers to hedge price risk. It allows investors to gain exposure without holding physical metal. It provides liquidity and helps with price discovery. But derivatives also allow for massive leverage. You can control a large amount of silver with a relatively small amount of capital. And this leverage multiplies throughout the financial system. Here's what that looks like in practice. A bank might write options contracts on silver. An investment fund might buy those options. Another institution might create a structured product based on those options. A fourth party might buy swaps tied to the performance of that structured product. Each layer adds leverage, each connection creates counterparty risk, and the entire structure rests on the assumption that if someone wants to settle in physical silver will be available at something close to the contract price. What happens when that assumption breaks down? This isn't a purely theoretical exercise. We've seen versions of this dynamic play out before in different markets. In the late 1970s and early 1980s, the Hunt brothers attempted to corner the silver market. They accumulated huge positions in both physical silver and silver futures. As the price rose, exchanges changed the rules, raising margin requirements and limiting positions. The market became disorderly. Prices spiked and then collapsed. But the key point is this. There was a moment when the paper market and physical market began to separate, when the normal mechanisms of arbitrage and settlement started to break down. More recently, we saw something similar in the nickel market in 2022. A massive short squeeze developed. Prices spiked so dramatically that the London Metal Exchange made the unprecedented decision to cancel trades and halt trading. Why? Because the normal functioning of the market had ceased. Participants who were supposed to deliver physical nickel couldn't do so at the contracted prices. When physical delivery becomes impossible or impractical at contract prices, markets don't just experience volatility, they experience structural breaks. Rules get changed. Contracts get settled in cash instead of physical delivery. Trust in the market's integrity erodes. And that's the concern being raised about silver right now. Not that it will happen tomorrow, but that the conditions exist for this kind of structural break to occur. So what specifically has changed that's causing experienced analysts to raise these concerns? First, physical demand for silver has been increasing across multiple categories. Industrial demand remains strong, particularly from the solar energy sector. Investment demand has been rising as more people seek alternatives to holding cash in an environment of persistent inflation and currency debasement. Second, available physical inventory at exchanges has been declining. The registered silver available for delivery at COMEX, the primary futures exchange for silver in the United States, has dropped significantly over the past several years. This is metal that's specifically designated as available to fulfill futures contract delivery obligations. Third, the ratio between open interest in futures contracts and available physical inventory has been widening. More contracts are outstanding relative to the metal available to settle those contracts if delivery is requested. Fourth, premiums for physical silver over the spot price have been elevated and persistent. When you go to buy actual silver coins or bars, you're paying significantly more than the quoted spot price. These spreads suggest tightness in the physical market that isn't fully reflected in paper prices. And fifth, there are reports, difficult to verify but coming from multiple sources, of delays in delivery of large physical orders. Institutions or wealthy individuals placing large orders are being told to wait weeks or months for delivery. That's unusual in a well-functioning market. Individually, any one of these factors might not be alarming. Collectively, they paint a picture of a market under stress, where the gap between paper claims and physical availability is creating tension. Let's walk through what would actually happen if a significant delivery failure occurred, not to fearmonger, but to understand the mechanics so you can assess the risk intelligently. Imagine you're an institution that sold silver futures contracts. You've promised to deliver a certain amount of physical silver at a certain price on a certain date. You sold these contracts because you believed the price would fall, or you were hedging another position, or you were providing liquidity to the market. Now, imagine that delivery date arrives and you don't have the physical silver. Maybe you thought you could buy it easily when needed. Maybe you thought most contracts would be cash settled rather than delivered. Maybe you simply miscalculated. You have a few options. You can try to buy physical silver in the market to fulfill your obligation. But if many sellers are in the same position, or trying to buy physical at once, the price spikes rapidly. You might have to pay far more than the contract price to obtain the metal. Or you can request to settle the contract in cash instead of physical delivery. But if the buyer insists on physical delivery and the exchange rules require physical delivery, you're in default. Or the exchange itself might intervene, changing the rules to allow cash settlement, or limiting delivery or halting trading. This has happened before in other markets. The problem is that once participants in a market believe that physical delivery is uncertain, behavior changes. More people demand delivery, fewer people are willing to sell, liquidity evaporates, price discovery breaks down. And because the silver derivatives market is connected to the broader derivatives market, stress in one area can spread. Banks and institutions that are counterparties to silver derivatives might face margin calls or collateral demands. These can create liquidity pressures that affect their other positions. This is where the title of this video becomes relevant. Why would a failure to deliver silver potentially trigger problems in the broader derivatives market? The global derivatives market is enormous. Estimates put the notional value at over $1 quadrillion. That's a number so large it's difficult to comprehend. It's more than 10 times global GDP. Now, notional value isn't the same as actual risk exposure. Most derivatives offset each other. The net risk is much smaller than the gross notional amount. But here's the critical point. The system depends on confidence and liquidity. Modern financial markets operate on the assumption that contracts will be honored, that counterparties will perform, that settlement will occur smoothly. When that assumption is violated in one market, it raises questions about other markets. If a major institution defaults on silver delivery obligations, other institutions start asking, what else might they be unable to deliver? What other positions are at risk? Should we reduce our exposure to this counterparty? This questioning leads to defensive behavior. Credit lines get pulled, margin requirements increase, liquidity dries up, and in a highly leveraged, interconnected system, liquidity problems can cascade rapidly. We saw this dynamic in 2008. The immediate trigger was subprime mortgages. But the real problem was that when participants lost confidence in the value of mortgage-backed securities, they started questioning the value of all complex derivatives. Counterparty risk became the dominant concern, and the seizure in credit markets spread far beyond housing. Could a silver delivery failure be a similar trigger? Not necessarily. The silver market is much smaller than the mortgage market was in 2008. but the derivatives market is much larger now than it was then. And the lesson from 2008 is that it's not always the size of the initial problem that matters. It's whether that problem exposes vulnerabilities in the broader system. There's another dimension to this situation that's worth understanding. Central banks have been accumulating gold at the fastest pace in decades. This is public information reported in their official reserves. Silver isn't as commonly held in central bank reserves, but it has a historical relationship to gold. Both metals served as monetary reserves for centuries. Both have been viewed as alternatives to fiat currency. When central banks accumulate physical gold, they're making a statement. Whether they acknowledge it or not, they're diversifying away from fiat currencies. They're preparing for a world where the dollar's dominance might not be guaranteed indefinitely. This matters for silver because increased concern about currency stability tends to drive demand for monetary metals if confidence in fiat currencies erodes further. If inflation remains persistent, if debt levels continue to climb without restraint, then more investors will seek hard assets. And silver, as the more accessible monetary metal compared to gold, could see significant demand from retail investors and smaller institutions. This isn't about predicting collapse or hyperinflation. It's about recognizing that central bank behavior and currency dynamics affect the demand side of the silver equation, and increased demand intersecting with a market already showing supply stress creates conditions for potential disruption. Let me speak directly to those of you who already hold physical silver. You're probably wondering what this analysis means for your position. First, understand that if the concerns about delivery failure and market stress are valid, you are on the right side of the equation. You hold the physical asset. You're not exposed to counterparty risk. You're not dependent on someone else's promise to deliver. If a delivery failure occurs, if the paper market and physical market begin to diverge significantly, the value of physical silver in your possession could increase substantially relative to paper claims. This has happened in other markets where physical scarcity emerged. But here's what's equally important. You need patience and discipline. Structural changes in markets don't happen overnight. Even if the analysis is correct, the timeline is uncertain. There could be months or years of apparent calm before any serious disruption occurs. Don't let this analysis tempt you into emotional decision-making. Don't suddenly decide to overcommit resources to silver based on fear of missing out. Don't check prices obsessively. Don't trade in and out trying to time short-term moves. If you bought silver as a long-term hedge, as insurance, as a store of value outside the banking system, then that thesis remains valid regardless of short-term price action. These structural concerns we're discussing only reinforce the original rationale for holding the metal. What you should do is continue to educate yourself. Understand the difference between physical and paper. Understand how to verify the authenticity of what you hold. Understand storage and security. Understand that the real value of holding physical assets comes from patience and perspective, not from constant trading or speculation. Now, let me address those of you who don't currently own silver, but are considering it after hearing this analysis. First, be very careful about rushing into any decision based on fear or urgency. The worst financial decisions are made when people feel they have to act immediately without proper understanding. If the analysis about market structure and potential delivery issues is correct, that doesn't mean you need to buy silver tomorrow. It means you should take time to educate yourself, to understand what you'd be buying and why, to assess your own financial situation and goals. Owning physical silver makes sense for many people as part of a diversified approach to preserving wealth. It's a tangible asset that's been valued for thousands of years. It has no counterparty risk. It can be created out of thin air by central banks or governments. But it's not suitable for everyone, and it's not suitable for all your resources. If you're living paycheck to paycheck, if you don't have an emergency fund, if you're carrying high-interest debt, then buying silver should not be your priority. If you do decide to allocate some resources to silver, start small. Buy physical metal from reputable dealers. Don't buy on leverage. Don't buy complex silver investment products you don't fully understand. Don't put money into silver that you might need in the next few years. Understand that physical silver doesn't produce income. It doesn't pay dividends or interest. Its value comes from its monetary properties and industrial utility, not from cash flow generation. So it should be part of a broader strategy, not your entire strategy. And be prepared for volatility. Silver prices can swing dramatically. If you buy and the price drops 30%, can you hold without panicking? If not, you haven't properly assessed your risk tolerance. The most important thing is this: if you buy silver, buy it with conviction based on your own understanding, not because someone on the internet said there's going to be a crisis. Your conviction comes from education and alignment with your values and long-term goals, not from fear or hype. To understand why physical assets like silver matter in the current environment, you need to understand the broader macroeconomic context we're operating in. For over a decade, we lived in a world of near-zero interest rates and massive central bank intervention. These created distortions throughout the economy. Asset prices inflated, debt levels soared, financial engineering replaced productive investment in many sectors. Then inflation returned. Central banks had to raise rates. The cost of servicing debt increased. Governments, corporations, and individuals all faced higher borrowing costs. This created stress in the system. Now we're in a transitional period. Inflation has moderated, but remains above target in many economies. Interest rates have been raised, but are starting to be cut again. Debt levels remain extraordinarily high. The question is whether central banks can navigate a path that avoids both runaway inflation and severe recession. History suggests this is very difficult. When debt levels are as high as they are now, when the economy has become dependent on cheap credit, raising rates enough to truly control inflation risks triggering defaults and financial crisis. But keeping rates to low risks losing control of inflation expectations. This is sometimes called the debt trap. Too much debt makes it impossible to raise rates high enough to control inflation without breaking the economy. So central banks oscillate between tightening and easing, never fully solving either problem. In this environment, hard assets with no counterparty risk become more valuable. They are not promises from governments or corporations. They are tangible stores of value that exist regardless of monetary policy or credit conditions. This doesn't mean silver or gold will go up in a straight line. It means that over longer time horizons, as the structural problems in the debt-based monetary system become more apparent, more people will seek alternatives. One of the most important things to understand about markets is that they're driven as much by psychology as by fundamentals, and psychology moves in cycles. Right now, most mainstream investors are not thinking about silver. They're not worried about delivery failures or derivatives risk. They're focused on stocks, on the latest tech trend, on whatever CNBC is discussing today. This is normal. Markets go through long periods where certain assets are ignored or dismissed, followed by relatively brief periods where everyone suddenly becomes interested. If you study market history, you'll see this pattern repeat. Gold and silver were dismissed throughout most of the 1980s and 1990s. Then from 2001 to 2011, they were in a major bull market. Then they entered another period of being largely ignored. Now, interest is starting to return. The investors who do well over time are those who pay attention to fundamentals and structure when everyone else is distracted. They buy assets that are undervalued or underowned relative to their fundamental importance. Then they wait patiently while the cycle turns. This requires emotional discipline. It means being comfortable owning things that aren't popular. It means being able to tolerate periods where nothing seems to happen. It means not being shaken out by volatility or by the ridicule of others who don't understand what you're doing. If the analysis about silver market structure is correct, we're potentially in the early stages of a shift in investor psychology. More people are starting to notice the supply constraints. More people are asking questions about derivatives risk. More people are looking for alternatives to fiat currencies. But this shift doesn't happen overnight. It unfolds over months and years. And it includes periods of doubt, periods where the price doesn't reflect the underlying fundamentals, periods where it seems like nothing is changing. The investors who benefit are those who understand the cycle, position themselves appropriately, and then have the patience to wait for the rest of the market to catch up to what they already understand. Let me be very clear about what you should not do based on this analysis. Do not sell assets you need or liquidate your emergency fund to buy silver. Do not borrow money to buy silver. Do not buy on margin or use leverage. Do not buy exotic silver derivatives or complex investment products you don't understand. Do not make this your entire financial strategy. Do not put all your resources into one asset class, no matter how convinced you are about the thesis. Do not panic if the price drops after you buy. Do not check prices every day and let short-term movements affect your peace of mind. Do not trade in and out trying to catch every swing. Do not listen to people online who promise you silver is going to a specific price. By a specific date. No one knows the future. Anyone who claims to know exact outcomes is either delusional or trying to manipulate you. Do not let conspiracy theories or apocalyptic scenarios drive your decision-making. The analysis about market structure and delivery risk is serious, but it doesn't require believing in vast conspiracies or inevitable collapse. Do not ignore your other financial responsibilities. Pay your debts. Build your emergency fund. Invest in your skills and career. Take care of your health. Silver is one tool in a comprehensive approach to financial security, not a magic solution. And do not stop thinking critically. Continue to evaluate the thesis. Continue to look for evidence that supports or contradicts the analysis. Be willing to change your mind if the facts change. Intellectual humility is crucial in investing. The most dangerous position you can be in is certainty. The most valuable position is informed conviction combined with genuine openness to being wrong. Let me frame this entire discussion in terms of probability, because that's how rational investors think. Is it certain that a silver delivery failure will occur? No. Markets can remain irrational or structurally flawed for much longer than seems possible. Mechanisms exist to paper over problems, to change rules, to postpone reckoning. Is it probable that the current structure of the silver market contains significant risk? Yes. The disparity between paper claims and physical availability is real. The leverage in the derivatives market is real. The tightness in physical supply is increasingly evident. Is it possible that this risk will eventually manifest in some form of market disruption? Yes. The historical precedent exists. The incentives exist. The structural conditions exist. What's the expected value of preparing for this possibility? This depends on your individual circumstances. But for most people, allocating some portion of savings to physical assets with no counterparty risk is a sensible form of insurance. Think about it like this. You pay for homeowners insurance even though you don't expect your house to burn down. You pay for car insurance even though you don't expect to have an accident. You do this because the cost of the insurance is small relative to the potential loss if the unlikely event occurs. Owning some physical silver can be viewed similarly. If the market functions normally, and no disruption occurs, you still hold an asset that's been valued for millennia, that has industrial utility, that serves as a hedge against inflation and currency debasement. If a disruption does occur, if delivery failures happen, if the paper market and physical market diverge significantly, then you're positioned on the right side of that equation. This is not about making a binary bet where you're either right or wrong. It's about acknowledging uncertainty, assessing probabilities, and positioning yourself in a way that makes sense regardless of which specific scenario unfolds. Here's something most people don't realize. In markets, information is not evenly distributed. Some participants understand structural dynamics better than others. Some pay attention to warning signs earlier than others. This doesn't require insider information or illegal advantages. It simply requires effort, attention, and the willingness to think independently. Most investors rely on mainstream financial media for their understanding of markets. They hear about silver only when the price spikes dramatically, if they hear about it at all. They don't understand the difference between physical and paper markets. They don't think about derivatives risk or delivery mechanisms. This creates an opportunity for those willing to do their work. If you understand the structural issues in the silver market, if you understand the relationship between debt, inflation, and hard assets, if you understand market cycles and investor psychology, you have an advantage. Not an advantage that guarantees profits or eliminates risk, but an advantage in the form of better understanding, better preparation, better positioning for various scenarios. The question is whether you're willing to invest the time and effort to develop that understanding. Whether you're willing to read beyond headlines, to study how markets actually function, to think through scenarios that others dismiss. Most people won't make that effort. They'll hear about these issues only after they've already played out, when prices have already moved, when positioning becomes crowded. Your advantage comes from acting while the crowd is still distracted, while mainstream consensus still dismisses these concerns, while the opportunity to prepare is still available. Let's zoom out and look at the global supply picture for silver, because this provides important context. Silver is mined both as a primary product and as a byproduct of mining other metals, like copper, lead, and zinc. The majority of silver actually comes as a byproduct. This means that silver supply is not highly responsive to silver prices in the short term. If the price of silver doubles, you can't just open new silver mines quickly. Most silver production is tied to the economics of other metals. New mines take years to develop. Existing mines have limited ability to increase output quickly. On the demand side, industrial use has been growing steadily. The transition to renewable energy, particularly solar power, requires significant amounts of silver. Electric vehicles use more silver than traditional vehicles. The electronics industry continues to grow globally. This creates a structural dynamic where supply is relatively inelastic and demand is growing. In normal markets, this would lead to steadily rising prices. But because the price is heavily influenced by the paper market, the physical supply-demand imbalance can persist without fully reflecting in the price. Until it does. And when physical supply constraints begin to bind, when inventory levels drop too low, when delivery requests can't be satisfied, the adjustment can be rapid and dramatic. We are seeing early signs of this in elevated premiums for physical metal, in delivery delays, in declining exchange inventories. Whether this develops into a full-blown crisis or remains a slow-burning issue is uncertain. But the direction is clear. Physical silver is becoming more difficult to obtain in large quantities. And in a world where more investors may seek physical assets as a hedge against monetary instability, that constraint matters. As we move toward the conclusion of this analysis, I want to bring together the key themes and discuss what it means to position yourself thoughtfully in an uncertain environment. We live in a time of unusual monetary conditions. debt levels that would have been unthinkable a generation ago. Central bank balance sheets measured in trillions. Persistent inflation despite official assurances it's transitory. Currency debasement through endless money creation. Against this backdrop, the structural issues in the silver market take on greater significance. A potential delivery failure isn't just about one metal or one market. It's a symptom of broader dysfunction in a financial system built on leverage, derivatives, and the assumption that paper claims are equivalent to physical reality. For thoughtful investors, this creates both risk and opportunity. Risk because we're operating in a system with unprecedented levels of leverage and interconnection. Opportunity because those who understand these structural issues can position themselves before the broader market recognizes them. The key is to approach this with balance. Recognize the risks without becoming paralyzed by fear. Recognize the opportunities without becoming reckless with greed. Prepare thoughtfully while maintaining perspective. This means allocating some resources to physical assets while maintaining liquidity. It means educating yourself while avoiding information overload. It means being patient while staying alert to changing conditions. Most importantly, it means maintaining your discipline regardless of what others around you are doing. When everyone is panicking, you stay calm. When everyone is complacent, you stay prepared. Your anger is your understanding, not the crowd's emotion. So where does this leave us? What should you actually do with this information? First, commit to continuous education. This video provides a framework, but your understanding should continue to deepen. Read about monetary history. Study previous commodity market squeezes. Learn how derivatives actually function. Understand the relationship between debt and inflation. Second, assess your own situation honestly. What are your financial goals? What's your risk tolerance? What's your time horizon? Your decision should flow from your specific circumstances, not from abstract analysis. Third, if you decide physical silver makes sense for you, take action thoughtfully. Research reputable dealers. Understand the difference between coins and bars. Consider storage and security. Start with amounts you can afford to set aside for years. Fourth, maintain balance in your overall approach. Silver might be one component of a diversified strategy that includes emergency funds, income-producing assets, skill development, and other forms of resilience. Fifth, cultivate patience. The most important market cycles play out over years, not days. Your ability to wait while others panic or chase is often the difference between success and failure. Sixth, stay humble. No one has perfect information. No one can predict the future with certainty. Hold your views lightly enough to change them when evidence changes, but firmly enough to act with conviction. And finally, remember why you're doing this. Not to get rich quick. Not to prove you're smarter than everyone else, but to protect and preserve what you've worked for, to provide security for yourself and those you care about, to maintain independence in a world of increasing financial complexity and risk. We've covered a lot of ground in this analysis. The structural issues in the silver market, the relationship between physical and paper, the role of derivatives in amplifying risk, the broader macroeconomic context of debt and inflation, the investor psychology that drives market cycles. The common thread through all of it is this: understanding matters more than reacting. Knowledge matters more than speed. Preparation matters more than prediction. The investors who navigate uncertainty successfully aren't those who react fastest to every headline. They're those who develop deep understanding of how systems work, who position themselves thoughtfully based on probabilities, who maintain discipline when others panic or become euphoric. If a silver delivery failure occurs, if the derivatives market experiences disruption, it won't be a complete surprise to those who've been paying attention. The warning signs have been building. These structural vulnerabilities have been visible to those willing to look. But even if nothing dramatic happens, even if the system muddles through for years longer, the underlying principles remain valid. Physical assets have value. Diversification provides resilience. Understanding how markets actually function gives you an edge over those who simply follow the crowd. Your goal isn't to predict the exact moment of market disruption. Your goal is to be prepared for various scenarios, to understand the forces at work, to position yourself in a way that makes sense regardless of timing. This is the difference between speculation and investment. The speculator needs to be right about timing to profit. The investor builds positions based on value and structure, knowing that over sufficient time horizons, reality tends to reassert itself. So, continue learning, continue thinking critically, continue making thoughtful decisions based on your own understanding and circumstances. Don't let fear drive you. Don't let greed mislead you. Don't let the noise distract you from what matters. The financial landscape is changing. The old certainties are being questioned. The structures that seem permanent are showing cracks. For those with eyes to see and the discipline to act on what they understand, this creates opportunity. But that opportunity is available to the patient, the thoughtful, the prepared, not to those chasing headlines or looking for shortcuts. You now have a framework for understanding the issues in the silver market and their broader implications. What you do with that understanding is up to you. Choose wisely, act thoughtfully, stay disciplined, and remember that in uncertain times, your greatest asset is not what you own, but what you understand. Thank you for your time and attention.